So once you understand under topic 2, sales ledger and purchase ledger, again, automatically you will understand accounting for asset and liability. So what we do as a want.
Okay.
Sales ledger control account and purchase ledger control account. That's what they normally examine in exam. But the other part, I will send you so that you read for the knowledge, but not the purpose for exam.
Okay.
Yeah.
Okay, fine.
So because we are looking at a sales ledger and purchase ledger.
Yeah.
So I want to begin from a simple step. So in this process, you have to, like we have said earlier, we have like sales channel, and we have the sales account, that is the personal account. And so in ledgers, when you say a ledger is a book where you record a transaction.
Yeah.
So when you sell good, which account do you record that one? Or if you sell good in sales account, do we credit or debit?
When you sell?
When you sell good. Yes?
Okay, I'm getting you. When we sell goods.
Yes, when you sell good.
The accounts that are shared.
Yes?
We have the sales account.
Sales account
and the stock.
And the stock. So we are reducing the stock, but we are reducing stock, right?
Yes, yes.
And we are increasing our sales. So when you say it's like you sell goods on cash basis, you debit the cash account because you are receiving cash. Yes. And then you credit a sales account, because sales account is an income account. That's why we are crediting. So now sales ledger control account or purchase ledger control account, these are accounts which we normally use to control the sales on credit. What you sold on credit to customers. Yes. You can't hear me?
Yes, yes.
I'm saying
yes.
So let's have 1 minute to I check this net. So we say a controls account, we use this one to control sales on credit. Mostly sales ledger control is on sales credit. So that you don't find that the customers who are selling on credit, they just disappear and then you don't have the record. So you must have the record. And so here is the format. So on our debit side, we will have the balance pro down, that is the outstanding balance from the previous year. And then the credit sale for this year, the current period. And then this one is a dishonored check. So dishonored check, the customers had paid you, but once you deposit this check to the bank, you find that it is invalid or there is a bond check. So previously, where was this check? Ulfo may record what with this transaction. Where did you record this transaction first before you debit in the sales ledger control account?
The check.
The check. The customers paid you.
On the.
Yeah, so I want you opened, say for me, the journal entries. you could have made. The customer pays you a check in form of
That
check.
is the sales, in the sales purchases, in the sales journal.
In the sales journals, yes. I assume the customers pays you in form of check. Which account do you create?
I normally create sales
Sales account.
account
We credit
and
sales we credit sales account or we debit.
we credit.
We will credit sales account, right? Then what happens now when these customers pays you?
When he pays me, that is an increase in my. I've been paid.
Yes, you have been paid.
So my bank account has increased.
Your bank account has increased. So what happened to that bank account? You debit or you credit? You debit, right? So that's why this dishonored check we are reversing. Earlier on, we are in our sales income account, we got to make credit as these customers has paid us. Now we find that this check is not right, maybe due to the error or the name, because there is some reason which might give a dishonored check. So here you have to debit, and then there is another one, bad debt recovered. So you will find that the customer will pay. Those customers you have decided to write off, they will come and pay you after a period of time. Then now we will treat them as bad debt recovered. We have already write off. Like you can see in our credit side, we have the bad debt written off. That one. So we
Okay.
have already written off this one as a bad debt written off. But later on, these customers comes and pay us. Then now we can what? Do
Debit.
a transaction with debit. And then so about cash received from debtors and cash checks, there is no problem with that. Credit note. So this is the credit note. You see here we have the total credit sales, right? That is our total
Yes.
credit sales. Now, these customers has returned goods and not that it is on debit side, it is on debit side. Now he or she has returned goods that may be due to the damage or a wrong quantity or wrong packaging. Now we have to remove that return by raising a credit note. We credit the value, this one. So
Okay. On
umeelewa?
the sale,
Yes.
to go on the check received from debtors, credit. Yeah.
Yes, we credit. That is the payment receipts.
Okay.
The same case with cash receipt from the debtors, and the same case with cash received to replace a dishonored check. You see, dishonored check is here, right? So you inform the customer that this check is not good. Then now they can decide to pay you in form of cash. So that's now when you credit the cash received to replace this dishonored check. And the same, we go to the credit note. The credit note happens when the customer return goods. So you have to raise a credit note.
Okay.
And this credit note will reduce the amount of credit sales we have made. This one.
It is being written by the.
It is being written by the company, informing the customer that we have received the returns of your goods. So this is a return issued. See, I've told you there is a return issued and the credit note issued and credit note received. Hello? Hello? So I was explaining this one.
Okay.
The next one we know about discount allowed and return inward, right? So we don't have a problem with that. And this one is a bill receivable when the client pays you. It become now a bill to them, but for you is an income, so you have to credit that amount.
Okay. Any income from?
Yes,
Right?
any income the clients they are paying or the customers.
Okay.
And then the next one is a contra settlement. So do you have any idea about contra settlement?
I know of contra entry.
Contra entry, contra settlement, it is the same thing.
Okay.
Yes.
This is where we get transactions from within the account, from cash to bank within the same account.
Within the same account. That's when you do a contra entry within the bank, right? Within the company itself, sorry.
Yes.
But this one's now, we are doing a transaction with the customers. Let's say you sell goods to a company A, right?
Yes.
This company A is your customer. At the same time, this company A is your supplier. So,
Yes.
so instead, so you purchase good from this company A supplier. At the same time, you sell good to this company A as a customer, right? Maybe with the same amount of value. And then, so instead of this supplier paying you, they can decide to replace that amount with the what? The purchases you made.
Okay.
Yes. So you will find that this account will have to cancel each other off. In your account, you have to credit as if you have received that payment, right?
Yeah.
And again, in their account, they have to what? To indicate on debit side, that is contra settlement, as if they have what? They have made payment.
On the purposes account.
Yes, on the purchases account on their books.
But on the sales account, we credit.
You credit, so you treat that you have received that money, but you have not. So you have cancelled each that account, or you have write off that account.
Okay.
So that's the question which normally challenge most of the students. And we have the purchases, which is we use these purchases to control the credit purchases. And the same information we have here is like the one we have in the sales ledger account.
Okay.
So I want we turn to we do an illustration so that we understand more about this one. We look at September 2015. Do you have your past paper? So just open September 2015. We see a quotient there. September 2015. So we are looking at September 2015. September 2015. So it's November. The last page. Yeah, here is the question. So the question say Ali Limited has provided the following financial information for the month ended that 1st August 2015, right?
Yes.
So we have receivable debit balance as at 1st August 2015, that is 12 of 1.2 million. So again, you will begin on the, you see they have said the debit side. So it is not always, yes, it is not always on a debit side. Sometimes they might say on a credit, on a creditor side. So you have to check the question. So you have to see the question. And then the next one, we have payables, and we have the credit sales, the credit purchases, I mean. We have allowance for doubt, for irrecoverable debt, and we have credit sales. We have return inwards, discount received, return outwards. We have interest charge to credit customers on overdue accounts. We have receipt from credit customers and the discount allowed. We have payment to creditors, irrecoverable debt written off, that is bad debt, customers check dishonored, and payable ledger credit transfer to receivable. Additional information number 1. Amount of 200,000 previously written off were received in the month of August 2015. Number 2. Claims by early limited for price reduction in the month of August due to defective goods were approved by suppliers amounting to 150,000. Number 3. An invoice issued for 480,000 was omitted from the relevant day book. Required sales ledger control account 8 marks and purchase ledger control account 8 marks. That's an easy question so long as you have the format and you understand the principles, right?
Yes.
So now, having our format and the questions, let's try to replace the items in the format. We put the values. So I will share the screen. So you have the questions?
The question that you shared,
Yes.
in 1 minute I'll be
Okay.
through with it.
So when you are doing these questions,
yes,
you opened 2 accounts at once. Don't open one account, then you go and open another account. You open 2 accounts at once so that you, as you read, when you find transaction which relate to sales, you record. When you find transaction which relate to purchases, you record, right?
Yeah.
And then it will make it easier. So let's create an account for sales ledger control account. Sales ledger control account. I want we create account for sales ledger control account. So here is on debit and here on credit. Again, I will create an account here for purchase. Purchase ledger control. Control account. Again, I will have a debit and credit. So let's read the first information. The first information says what?
Question is still.
So the first information saying receivable debit balance as at 1st August 2015 is 1.2, right?
Yes.
That is our opening balance as what? As sales ledger. So you write here balance brought forward. Ngapi? 1200, right?
Yes.
So let's our account in millions. And then the same questions. If I may share the question, say payable credit balance as at 1st August 2015 amount to 800, right?
Yes.
That is the opening balance of the purchase ledger control account. So you go straight away, and debit in and credit in purchase ledger control account as what? A balance pro down or carried forward yang ngapi? 800, right? 800. The next statement in read it nini?
We okay.
You have not opened it?
Mine is, yeah, I have it. So what was the number?
Number 5, September 2015. Question 5, the last one.
September 20. Let me check it first. You've arranged them in that order?
Yes. We have the sales ledger control account and purchase ledger control account.
September 2015, number 5.
Number 5, yes.
Is this the same question? The one that is called pilot paper?
Yes, the pilot paper, the last one, the last question on that pilot paper.
Let me check. Oh yeah, good. I'm there.
Okay. So you have seen we have dealt with the first two information.
The balance breakdown for sales was.
Yes, so you have to debit that one.
The receivables debit balance.
Yeah, so that is the balance in the sales ledger control account.
Oh, now they have used another name of the receivable.
The receivable. That's the tricky part of it. Huh? And then the another one is payable.
The payable that is on purchases. Huh?
On purchases. So you have to credit the purchases ledger control account.
Yeah, now we can go now.
Then, so now you can read for me the next statement.
The next statement says credit purchases 1,840.
So in our format of sales, credit purchases ilikuwa side gani? It was on a debit, sir?
Debit side.
On a debit side. So we have to write now that one, credit purchases. So we write here credit purchases. A credit sales, sorry, of how much?
2,840.
So I have cut the zeros. Let's use the, I have cut in millions. So let's use in thousand, like 1,200. So I want to cut 3 zeros. It's like 480.
Okay. Kindly, before we proceed, the credit purchases.
The credit purchases, not the credit sales, eh?
That is credit.
Is it? Yeah,
In the
credit sales, credit purchases. Thank you. So credit purchases, we credit under purchases account.
yes,
How much?
2,840.
4,840. 2840. The next one.
Next is allowance for irrecoverable debts. That was on 30th June 2009.
So as you can see, our format, we don't have that allowance, right?
Yes.
That is the provision. The company, the company estimated that coming next year we will not able to collect this amount, right? So that is an estimation, is a provision.
Mm.
So it will not appear anywhere in our sales ledger control account. Yes. So the next one.
So we don't treat it.
Yeah, so we don't treat so, but if it was an income statement, there is how we treat them. They have to give us the provision for last year and the provision for this year, and then we check if there is an increase or decrease, then we record it as expense or an income. We will do that later on with other questions.
Oh, so for the purchases and sales account, sales control account, we don't
we don't factor in any that provision, huh?
Okay.
Yes.
So now we go for credit sales.
The credit sales. So they have a credit sales. So credit sales you debit on credit sales ledger.
On the sales ledger.
Yes.
We debit.
We debit, yes. How much?
It is 3,630.
They want, okay. That's 630. And then to the next one.
Returns inwards.
We have return inwards.
Inward.
So as now I know you have now understand the return. What is a return inwards?
Returns inward. These are good. That are
the customer is returning goods, right?
The company.
Yes, the customer is returning goods to the company, right? So this the value the customer is returning is included here in credit sales. Are you seeing that one?
Yeah, yes.
So it is included there. So now we want to remove that value by what? By crediting. So we write here return, the return inward.
Oh yeah, yes.
Return inward.
Because we'll have to return to remove it from
from our books. It will reduce the sales value. Of how much?
100.
How much?
100.
100. Now there's one thing we are missing.
Okay.
On credit sales, see the additional information note 3.
Additional information note 3, an invoice issued of 480,000 was omitted from the relevant day book.
Was omitted from the relevant day book, right? Meanwhile, these sales we are recording this credit sale, it is from our relevant day book, right? And this value of 480 is not existing in any of these relevant day book. Meanwhile, we have to add back that value, right? Yes. So here now will be 36, 30 plus 480, because it is they omit. So that the total value of credit sales come to 4110. They have not, you see, this credit sales, we are getting it from our sales account, sales journals account, and the 480 is not included in the sales journals account. So we have to add it back.
Okay.
Yes, because they have not recorded that value.
It is an invoice that was issued.
That was issued. You see, all credit sales are from, we raise an invoice to when we are selling on credit, right? So meaning
Yes.
we omit some value. Instead of raising this invoice, we didn't raise that invoice. So,
And that is a lot.
yes? Yes?
It needs a lot of thinking.
I?
It needs a lot of thinking because you might end up not
Yes.
getting it.
Yes, need a lot of thinking. That's why financial accounting, once you understand the concept and how you digest it, but if you assume everything is okay, that's why if an accountant student doing CPA, once they see additional information, now that's when the problem starts.
Oh, the
In fact,
what if
yes,
actually go with it
yes,
uh, up to the end where the payables, ledger credit transferred, then we go to the additional information.
no,
Will there be?
it will be a big problem because you have to adjust any transaction as you go. You see the additional information, then you check the one which is related. You adjust. That's why it is good. You start with the additional first for any adjustment before even you come to the one which you have provided. Yes, like even the additional number one we could have dealt with, so that as we go down we don't left the other information.
Okay.
Like we can even start with the additional number one. They say what amount of 200,000 previously written off were received in the month of August 2015, right? We have already write this one as a bad debt. Tulisema bad debt tunaweka site gani?
Bad debts.
Yes, bad debt in a format. Tulisema tunaweka site gani?
It is in the sales ledger, the debit side.
Not bad debt written off, not bad debt recovered.
It's written on the credit side.
On a credit side. So previously you have written a value amounting to 200,000 on a credit side, but later on this customer has paid you, so you have to what to debit as a bad debt recovered.
Oh, so when we recover, oh yeah, so I get it.
So that's now that information 200,000 previously written off was received in the month of August. So they will not tell you directly this is the bad debt recovered, right? So you have to analyze it and you understand that is.
So we can.
Yes. Yes. So let's
put it as bad debts recovered. Eh?
Yeah. So it will be bad debt recovered. Yeah.
The sales account.
In the sales account.
Okay.
Bad debt recovered. Of 200. Then the next additional information number 2, they say what?
Additional claims by early limited for price reduction in the month of August due to defective goods was approved by suppliers amounting to 150,000.
150,000, right? So how do you understand such a statement?
Claims by early for this reduction.
Ali is the company, right? So they purchased, yes?
They purchased goods.
They purchased goods from the supplier.
Yes.
And
but defective of the goods, the price was reduced.
The price was reduced, right? So earlier on, where was this price in our accounts, in our purchase ledger control account? It was on which side?
On the credit side.
On the credit side as a credit purchases, right?
Yes.
So now we have now find that these goods are defective. Now we have to reduce the value. So again, so you have to reduce the value in your what? In your purchase ledger control account. So we can call it a debit note, right?
Yes.
Debit note. We raise debit note to correct undercharge or overcharge, right?
Yes.
Yeah, so we will raise a debit note for that 150 so that we reduce the value in the one we have it in our credit purchases here. So you call it a debit note so that we reduce that value. So now we are through with additional information. We can now go back to the one we have been provided.
Now we go to discount received.
Discount received is an income. If you buy a discount received is an income, but for supply itself is an expense. So it is a discount allowed in the supplier side, right? So, but for us, we have to debit on purchase ledger control account. Discount
Received.
Discount received. How much?
Of 9. No. Yes, 9.
9. Right? The next statement is
Returns outward.
returned outward automatically that you returned good to the supplier, right? Meanwhile, we are reducing the credit purchases, and you can see our credit purchases coincide on credit, right?
Yes.
So you have to debit to offset that value. Say return outward. How much?
That is for 40.
40. The next one?
Next one is interest charged to credit customers on overdue account.
The interest charged on customers on overdue account. So that one, so you find that in a sales ledger control account, we have the credit sales, right? So if you don't pay on time, we have to add up an interest on such account. So meanwhile, we will bring that interest charge on a debit side. So that they increase the value the customer will pay because it is now the actual value plus the interest.
It is an income.
Yes.
It is an expense.
It is an income. It is an income because we are charging them an interest.
Oh, yeah.
Yes. It's like this one is like bank. You see, the bank, the interest charge is the one of the main income from the banks.
The bank charges.
Yes, you see, if you take loan from the bank they give you loan with the interest, right?
Yes.
And they treat them as an income. So the same case with this one. So you give the interest so that you discourage what? The late payment.
Okay.
Yes. So we put on a debit side interest charge. How much?
Charge 20.
20. Then the next statement.
Discounts allowed.
Discount allowed is an expense to the company. So we put in which side?
On the credit side.
On the credit side, on which account?
On the purchases account.
No, this is the sales. We are giving out a discount to our customer, right?
On the sales account, yes.
The sales account. We are not purchasing, we are selling. So you put a discount allowed. How much?
Discount allowed 6.
6. Then the next one.
Receipts from credit customer.
Receipt from the creditors. No, is it the creditors?
Credit customers.
So the customers has paid us. So you have to credit on a sales ledger control account. Because previously ilikuwa on credit side, that one. So now they have paid us. So you come here and say a receipt. From customers. How much?
2904.
2904. The next one.
The next one is payment to creditors.
Payment to creditors. Payment to creditors. So we are paying our suppliers, right?
Yes.
So we are reducing the credit purchases, which is on a credit side, by debiting the payment. So say payment to creditors on credit purchase account. How much?
2207.
2207. Next one.
The next point is irrecoverable debts written off.
Irrecoverable. So that one ni gani so?
These are the bad debts.
So we write bad debt. How much?
12.
10. There any other information?
Okay, bad debts for ledgers, control account.
Say there is a customer's check dishonored, right?
Yes.
So we say dishonored check, we put where?
Bad debts is 12, not 10.
It's 12.
Then customer's check dishonored.
We say dishonored check, we put on a debit side, right?
On the credit side of purchases.
Not on credit. That one was on purchases. Is this a dishonored check on purchases or the sales?
On the sales.
On the sales. So now come to the sales ledger control account. You debit, right?
Suppose it could be for the purchases. How could it have been?
So if it was for purchases, you have made payment to creditors. This one, like this one, right? And that check does not did not go through. So you what? You write off that check by crediting dishonored check.
Okay.
So it is the opposite with the sales. The customers have paid us here, this one, right?
Yes.
So we find that there's some check which are not going through from this sales receipt. So we have to remove it by debiting. Yes. So we write dishonored check. How much?
Dishonored check 50.
50, right? The next transaction.
The next transaction is payables, ledger credits transferred to receivables.
We transferred the transfer from a payment to receivable. So what is that transaction, or how do you understand that, such a transaction?
Payable ledger credits
transferred to a receivable of 240.
So this payables, these are purchases. Transferred to receivable. So that is it's an income.
It's an income on which side? So that's why examiner is so smart. Examiner knows that if I will write for you contra settlement, you know how to treat them, right? But they will come in another version like this one, and you will not understand. Yes. So this customer, they purchase a good what? 240, right? At the same time, They sales are goods what 240 to certain customer. Now they have what decide to write off in terms of interchange. So they transfer that one to what? A receivable. So it's a contra settlement menu. Because now they transfer to receivable, you have to receive in a receivable account by crediting 240, and then you debit the purchase ledger control account of what? 240 you may transfer, right? Yeah. That's
so we don't have.
yes.
We really have to factor it anywhere since it is a contract.
Yes, you have to factor it. So you will factor it in the sales ledger control on a credit side. So you will say a control settlement of sales ledger, or you can say sales of how much? To 40. And then again you have to show it in the purchase ledger control that you have transferred this sales. So you say control settlement. No, here you say purchases, you don't indicate the sales.
Okay.
And here you say contra settlement of sales. How much? To 40. Then now you can write off the account. So add for me this one, you less this one, and then you get the balance carried down.
From the purchases on
The sales.
Itself, huh?
Yes.
On the debit side of sales is 5560.
5560. So there is an meanwhile I'm wrong. Me nimepata 5580.
Let me redo it again.
And me, I don't have a calculator.
Doing it with Excel, huh?
Yes. So just confirm it.
5560.
Or you have not updated the credit sales. Your credit sales is it's 4110.
Yes, I have second 3630 plus 480.
Plus 480 will come to 4110 plus 1200 plus 200
plus 200, that is 5510
plus
plus
20,
6.
20 plus 20 interest charge.
Kuna 20 man.
Yes, interest charge. Ama ilikuwa ngapi? How much was it? Interest charge.
It was 24. I've put
20.
it in the ledger myself.
You put it on credit side.
The purchases ledger, in fact, on the.
Oh, it should be in interest charge. To may charge interest on our customers.
Okay.
Yes.
10 at 20.
20.
Okay. Oh, then that is the case.
Yes.
55, 80. Okay.
Then you subtract 100, 6, 2904, 12 to 40. So the balance will be carried forward.
23, that.
23, it should be 2318.
Let me try to 100,
6,
04,
12
12.
to 40.
Yeah, 2318.
So that is the balance carried forward. So you will start with that one in the next month, and then so you add again for the purchases. I know the credit side will be much. The credit side will be more.
So that will be the balancing.
So the balancing figure will be on a debit side.
From 59, 40. I think it should be on the other side.
It will be on debit.
The credit side, the balance, because I think 28.
It should
40.
not be. It should not be. Yes, the balance carried forward should be on a debit side, because you cannot have a balance pro down on a credit side and the same time you have the balance carried forward on a credit.
So
yes. So once you have seen the credit balance pro down, it's on a credit side, automatically the balance carried forward, it will be on a debit side. So it is 2840 plus 800 inakuja ngapi? That is 640, right?
It should be 994.
Yes, 994, the balancing figure. Okay. So that's how we prepare the sales ledger control account and purchase ledger control account. So go digest it and see. I give you assignment. Do for me November 2019.
November 2019.
Yes, November 2019. I think question which. It is a lot of mark. You can see that one is costing you like 16 marks, right?
Mark said that one I've already passed.
So if you understand the concept, there's a lot of free marks here. So the secret of passing these things is understand the concept, do more questions so that ukipatana nayo kwa exam umeshazoea.
In fact, I'll have to retreat from where we started until where we are.
So you find that most of the people, they fail exam, not because they don't know, but they wait after the last minute so that they want to refresh all things they have learned. Will you catch it in 1 hour? That's why even that's why the semester is running from 3 months or 6 months, so that you arrange your thought systematically. Once you are done with this one, you go to the next one. But now you find that the last minute you are rushing to catch all the content.
But sometimes it is too tiresome. Huh?
Yeah, it is tiresome. So you see, if you understand this one as we go, at the end you will not have a problem. You only find the part which you are not good at. So you want to make sure you are perfect on that instead of repeating what you know.
Okay.
I'm trying to find it. This November 2019. I don't know which question is that. November 2019, question 5C.
2019.
See, question 1 say, highlight 5 factors. Let me share this screen. Say, highlight 5 factors that an organization might consider when sourcing for accounting software, right? So we have so many accounting software. The accounting software is like QuickBook, Sage, Pastel, and also the Excel, right?
Mm.
So those are the some of the what the accounting software the organization might use to what automate their transactions. And if you have been asked, what are the some of these factors you are considering before selecting such a software? So once itakuwa gani?
You are looking at the
The question
cost.
one, yeah, the cost. You have to see the cost of that accounting software. Another one,
Maybe the time, maybe if it is time consuming or it
yeah,
is.
if it is time consuming or how long will it take for that accounting software to generate a report, a financial report, right?
Mm.
And also
Accessibility.
accessibility. Is it you accessing anytime, right?
Mm.
Another one is
Uh,
again you
can
have to
talk
see there. You can talk of the what the skill or the expert, right?
about
So there's
yeah.
there's so many factors, and then the other one for public sector features of public sector entity. So the features of public sector entity, you say these are what they are non-profit making. They don't make profit, right? They use IPSAS in the accounting system, right?
Mm.
And also you can go further and state the accounting what accounting period.
Okay.
Yes, around 10 you go with your 10 marks. Then now you come to the question C where I want now you toggle that question C. So read, you see like sales receipt discount allowed, you refer to the question you have done, you confirm, you check, and you attempt that. So tomorrow we will check that one before we proceed.
Okay.
Yeah, so make sure you attempt. I will check it tomorrow.
I will. I will.
Okay, thank you. Have a good evening.
Okay. Appreciate that. Thank you.